So without further ado, I would like to give the floor to William Acworth, who is Senior Project Manager at ICAP, where his focus is international carbon markets and emissions trading. He leads ICAP's technical dialogue as well as capacity building efforts and tracks policy developments in Asia, Europe, and Latin America. Will, you have the floor.
Okay, good morning, good evening, everybody, and welcome to this webinar on the ICAP status report. My name is William Acworth, and may I start by hoping that you're all safe and healthy and adapting to the evolving COVID-19 conditions that we're all living under at the moment. For ICAP, this meant that we had to complete the publication and processing of the ICAP status report through remote collaboration. And this was both challenging and enlightening in terms of what is possible through the remote collaboration tools that we're now all becoming accustomed to. However, we are delighted that we could launch the status report last week, and we thank you all for joining in today for what I hope will be a really interesting discussion. For those of you that are unaware, ICAP is the International Carbon Action Partnership, and we're an intergovernmental forum for jurisdictions that have implemented mandatory emission trading systems. We provide a safe and trusted space for policymakers to discuss key developments in their systems, capacity building for jurisdictions that are considering emission trading systems, as well as a knowledge hub for anybody that is interested in what is going on in the world of emission trading systems. And a key aspect of that knowledge hub is our annual status report, which aims to provide a snapshot of global development in emission trading systems. Indeed, this report is structured in 3 different sections. The first section provides key insights into policy developments in specific jurisdictions by carbon market experts or policymakers. The second section provides infographics that we hope can be used as aids to communicate key developments and trends in the world of emissions trading. And finally, we provide detailed fact sheets of what's going on in systems that have either been implemented, are under consideration, or are under development. "2019 was a good year for climate action, for public awareness of climate change, and as well for carbon markets. Through Fridays for the Future and other initiatives, we saw a global surge in attention on climate action and public support for climate change policies. We saw governments start to legislate or consider net zero targets and a whole range of new targets and policy measures that came along with this. Worldwide, emission trading systems continue to be a key piece of the mitigation puzzle. However, as is the theme of this year's ICAP status report, emission trading systems or other carbon markets will need to be constructed together with carefully crafted policy packages if we are going to unlock all the abatement potential that is necessary to achieve net zero by halfway through this century. You can read about how different jurisdictions are approaching this challenge through the signed articles of this year's status report. 2019 and the start of 2020 was also a good year for emissions trading systems. With Mexico launching their mandatory pilot emission trading systems, the number of systems implemented rose to 21. This reflects 42% of global GDP where an emission trading system is in place, and these systems cover close to 1/10 of global emissions. Indeed, several more systems are either under consideration or development in 2020 compared to this time last year. These systems are in geographically dispersed locations in both developed and emerging economies, as well as at different levels of government. If we look at the US, we can see that action is focused at a state level, with states such as Pennsylvania and Virginia readying their systems to hopefully future be linked to the Regional Greenhouse Gas Initiative. We also see a group of northeastern states that are busily preparing an emissions trading system for the transport sector under the Transport Climate Initiative. When we look at Europe, we see that Germany announced a new emissions trading system for the fuel sector that will run alongside the power and industry sectors that are covered by the European Union emissions trading system. In Central Asia, we saw Pakistan establish a climate change authority, and this climate change authority is currently considering what role emission trading systems might play for Pakistan in attainment of their NDC. Indeed, things are moving so quickly that since the cutoff date for this year's stats report, we saw new policy announcements in both the Philippines, where they've introduced a bill that would lay the foundations for an emissions trading system in the Philippines, as well as Montenegro, where its system is currently under development. And when we look at 2019, we also see positive trends for allowance prices. In fact, allowance prices increased by 22% on average across mature systems. Not only does the allowance price represent a real incentive for, to reduce greenhouse gas emissions, but auctioning of these allowances has also generated 78 billion US dollars since 2009. And this represents really important and valuable revenue that can be used to invest in other climate mitigation programs, or indeed to compensate socially disadvantaged groups. But the world has changed very quickly over the past months, and carbon markets have not been spared by the COVID-19 crisis. The current crisis will result in a period of much lower economic activity. The depth and the duration of the recession is difficult to currently predict, but what is clear is that we will see a drop in emissions around the globe, and this will translate into lower demand for allowances. Indeed, carbon markets are already responding, with prices falling across key jurisdictions, in a response to lower demand for allowances and also lower expected demand. However, demand shocks are not new to emission trading systems. In fact, this is an attractive element of a market-based approach, where prices will fall in times of lower demand, which will allow compliance to be easier for companies that may be under other financial stresses. And at the same time, policymakers have learned from previous exogenous shocks to emission trading systems, and now almost unanimously have inbuilt adjustment mechanisms that will provide some support to falling prices. These are in the form of reserve prices at auction in North America, or the Market Stability Reserve in the EU ETS that was implemented in 2019. In fact, some of these systems will introduce automatic mechanisms where if there's periods of sustained low prices or if surpluses persist, there will be an automatic cancellation or invalidation of allowances, such that in these systems, we will emerge from the COVID-19 crisis with lower caps. So as severe as the current crisis is, it will be relatively short term. I would like to close by pointing out that the climate crisis is not, and this decade remains incredibly important for making deep and permanent emission cuts if we are to have any chance of reaching the 2050 net zero targets. Therefore, here at ICAP, we expect to see a continuing trend of jurisdictions turning to carbon markets and emission trading systems in pursuit of their NDCs or other mitigation targets. Finally, for anyone that prefers the podcast format, I would also just like to plug that the SAS report was featured this week on the Resources for the Future podcast. So we will have a link on our SAS report page to this. And you can also find it by links to the RFF podcast. So thank you very much, and I'm looking forward to the discussion.
Next, we have Jason Gray, who is Chief of the Climate Change Program Evaluation Branch, which oversees and implements the Cap and Trade program at the California Air Resources Board. Jason is also part of the Governor's Climate and Forest Task Force, which focuses on forest protection and low emissions rural development. Jason, over to you.
Great, thank you. Thanks for the introduction and for hosting today's webinar. With all the uncertainty and rapidly changing circumstances that William mentioned, for all of us, it's a great thing to see how the International Carbon Action Partnership continues to bring us together, both in partnership and in learning. And congratulations to the Secretariat on the release of this year's report. I look forward to the conversation today.
Jason, sorry to interrupt. I don't think we see your presentation yet.
Apologies.
If you click on share screen, that should work. Otherwise, we can do it from here.
There we go. Is that working?
Yes, it is working.
Sorry,
thank you.
I thought it was up.
No worries, we can see it.
All right, still getting
Great.
used to remote technology here. Thanks, everybody. All right, so I'm going to provide a brief update on California's cap and trade program over the last year, and look forward to the conversation today. You've probably all seen this slide or your own versions of it many times. I believe variations may actually be included in the ICAP 2020 status report. But this, for California, continues to underpin our climate actions. These targets, which are quite similar to ones established elsewhere, were developed in turn by California's legislature, both in Assembly Bill 32 and later in Senate Bill 32, as well as by multiple governor executive orders out to 2050. An additional goal that is not shown on this chart is our goal of reaching carbon neutrality by 2045. These goals are not specific to one program. All of our climate programs in California are working together to help us meet our targets. And we are proud that our portfolio approach, which of course includes our cap and trade program, helped us reach our 2020 target 4 years early. However, we also know the challenges ahead to 2030, 2045, and 2050, and we continue to assess how existing programs and new ones will be needed as the trajectory becomes steeper. And no, today I won't have answers on what that future looks like, but we do include our analyses and our assessments in our scoping plan process, which is our essentially climate action planning process in California. And we update that at least every 5 years. So we're due for our next one around the end of 2022, which, as you all know, is actually much closer than it seems. Like all emission trading systems, the purpose of California's cap and trade program is laid out in the diagram on top of this slide. By setting declining caps and a steadily increasing carbon price, our ETS is targeting lowest cost reductions first and sending the long-term price signal for clean technology investments that are needed to meet our targets. And as part of our climate strategy work, through our 2017 scoping plan, we found that a portfolio approach of multiple measures that includes our cap and trade program would be 4 times less costly than alternatives that do not include an ETS within the portfolio approach. As I mentioned on the previous slide, based on all of our programs, we achieved our 2020 target in 2016 and continue to see slight declines in our most recent covered emissions from data year 2018. For our key milestones last year, we had new regulatory requirements to comply with recent California legislation, which for those who are following this, it's Assembly Bill 398. These amendments went into effect on April 1st, 2019. Most of these provisions won't have an actual effect until January 1, 2021, like our revised reserve and price ceiling structure and reduced offset usage limits. For most of 2019, our work was focused on continuation of program implementation. We continued to implement our joint auctions with Quebec. Our auction reserve price in 2019 was $15.62, and the 4 quarterly joint auctions last year resulted in slightly more than $3 billion in proceeds to the state of California. This money is being used for investments on climate reduction measures, and to date, our overall proceeds have been slightly more than $13 billion, and more than 50% of this funding is going to benefit disadvantaged communities in our state. We also continued to implement our compliance offset program and issued more than 26 million offset credits throughout the year. To date, since the start of the program, we've issued credits to projects located in more than 30 states throughout the United States. We also initiated a solicitation process for a new advisory task force, which I will discuss on the next slide. And our November 2019 compliance deadline, which required covered entities to surrender 30% of their 2018 covered emissions, saw another 100% compliance rate. In November of this year, 2020, we'll have another partial compliance surrender for 30% of 2019 emissions. Finally, and although this isn't listed on the slide, as it wasn't an amendment to our cap and trade program, Our board also endorsed the California Tropical Forest Standard at the end of last year. The standard provides a strong signal to value the preservation of tropical forests over continued destructive activities such as oil exploration and extraction, and ensures rigorous social and environmental safeguards for Indigenous peoples and local communities. The standard leverages nearly a decade of work from the Governor's Climate and Forest Task Force and expands upon existing norms and requirements of the United Nations and other international bodies, previous staff work, voluntary carbon market tools, and GCF task force member programs. CARB will proactively monitor implementation and progress made by jurisdictions who have adopted and or utilized the standard and report back to our board on progress being made. Finally, we've already been busy in the first part of 2020. In January, our board appointed 13 members to what is called the Compliance Offsets Protocol Task Force that I mentioned on the previous slide. This task force is mandated by statute to provide guidance to CARB, to my board, in establishing new offset protocols for the cap and trade program with direct environmental benefits in the state while prioritizing disadvantaged communities, Native American or tribal lands, and rural and agricultural regions. The task force held its first of what will be 3 public meetings on March 2nd. When I was trying to remember the date of that meeting, it seems so long ago, it was only a few weeks ago. Our thinking about how to approach the climate challenge is evolving, and as William mentioned, carbon neutrality is gaining importance. This concept is that to address climate change, the carbon dioxide and other greenhouse gas emissions generated by sources such as vehicles, power plants, and industrial processes must be less than or equal to the amount of carbon dioxide that is stored. The magnitude of climate change impacts will depend on when carbon neutrality is achieved. The latest science and recent IPCC reports tell us that we need to reach carbon neutrality globally by mid-century. In California, we have an executive order that calls for carbon neutrality by 2045, consistent with these IPCC reports. We've started holding workshops to solicit input from stakeholders in late 2018 and continued those workshops through 2019 and into this year. Our most recent workshop, which was conducted as a remote webinar on February 20th, was focused on the industrial sector and evaluating approaches to deep decarbonization while recognizing the importance of the industrial sector to local jobs in the statewide economy. All of our workshops and webinars are included on our website, and I expect we will have additional public discussions on carbon neutrality throughout 2020. Some of these workshops may inform future regulatory changes in the cap and trade program, although we do not have any schedule at this time for commencing an amendment process. I'll end by noting that for all of CARB's programs, and in particular for our cap and trade program, 2020 will see us continuing to be in implementation mode, even if we're working remotely. We released our May 2020 auction notice last Friday, and our next scheduled auction is on May 20, 2020. Thank you.
Thank you very much, Jason, for this update on the California Cap and Trade Program. Before I pass the floor to Chris, I would like to remind all participants that you can type your questions in the Q&A function at the bottom of your Zoom screen. Next up, we have Chris Hoagland, who is the Program Manager of the Climate Change Program at the Maryland Department of the Environment. He coordinates Maryland's GHG and economic impact analysis, and he represents Maryland in the Regional Greenhouse Gas Initiative, also RGGI, and in the Transportation and Climate Initiative. Thank you for joining us, and the floor is yours, Chris.
Great, thanks for having me, and thanks ICAP for all of your work and this report. Again, I'm Chris Hoagland. Good afternoon from Baltimore, Maryland. I'll talk about RGGI, the Regional Greenhouse Gas Initiative, and then I'll also mention a quick update on the Transportation and Climate Initiative, where TCI, the other relevant program that Maryland participates in. So for RGGI, the biggest news right now is that the program is growing. Just this year, the state of New Jersey renewed its participation after a regulatory process they completed last year. The map you see on your screen here shows the eastern United States with all of the RGGI participating states colored in green, now including New Jersey. I've highlighted the state of Maryland, my state, in red there. And looking ahead to future years, we're expecting the state of Virginia to begin participating shortly, as early as next year. And then also the state of Pennsylvania. They're working on a regulatory process to begin participating as early as 2022. Those sort of 3 additional states, New Jersey, Pennsylvania, and Virginia, combined are more than doubling the emissions covered by RGGI. And RGGI, of course, as many of you know, covers the emissions from power plants in the participating states. So that has been a major change for the program in the last couple of years, and looking forward to the next couple of years is its substantial growth to additional participating states in the eastern United States. And that's been sort of much of the focus of the participating states over the last couple of years is helping as those new states establish regulations to begin participating and preparing for the much larger market once they are in. In addition to the substantial growth in participation geographically, we are also looking forward next year to a number of improvements taking effect in the program that we agreed to in our 2017 model rule. That was the outcome of the last program review that the participating states held that began in 2016. We identified a number of improvements to the program, established them in the participating states via regulation, and they take effect next year. They include reducing the RGGI cap by an additional 30% from 2020 to 2030. That's on top of the substantial reductions in the RGGI cap that we've already achieved since 2014. It includes the addition of a new mechanism we call the Emissions Containment Reserve, or ECR, which is meant to automatically achieve additional emissions reductions if emissions reduction costs are low. That'll take effect beginning of next year, and also improvements to the existing Cost Containment Reserve, or CCR, which has been in place in RGGI for some time now, and is meant to mitigate high allowance prices if allowance prices rise beyond a predetermined threshold by releasing additional allowances to the market. Various improvements to that mechanism will take effect next year. And then also we've scheduled an additional round of bank adjustments that will begin next year and last for 5 years. And the bank adjustments are adjustments to the cap that the RGGI states make to account for extra allowances in circulation. So we'll count up all the extra allowances in circulation at the end of this year. This year is the final year of a compliance period for RGGI. So we'll count up all the additional allowances left in the market after accounting for compliance. And then we'll adjust the next 5 years caps downward by that same amount to account for that extra supply in the market. So all of those things will take effect next year and result in what we believe will be a very, very strong program, very strong cap that adapts automatically to any real world outcomes in a way to ensure that the program is still delivering the benefits we would like to see. So this graph here shows how those various mechanisms will work together to affect what the RGGI cap is over the next 10 years. The RGGI cap is the solid black line here. You see that it dips from 2021 through 2025 because of the bank adjustments that are meant to remove any slack from the allowance market in the first half of the decade. And then the green shaded area here represents how much lower the cap could be due to the Emissions Containment Reserve, or ECR, which automatically tightens the cap by up to 10% in the participating jurisdictions if reductions are inexpensive, by which we mean if allowance prices fall below predetermined trigger prices that begin at $6 per ton next year. That could bring the cap graphically here down into the green area. And then on the other side, if allowance prices are high, if they're above $13 per ton starting next year, then the Cost Containment Reserve, or CCR, will increase the number of allowances entering circulation in order to mitigate high prices, and it could raise the cap to anywhere represented by raise the cap by up to 10%, represented by the orange area on this graph here. So we're excited for what the program will look like in 2021 once all of these improvements take effect, and we will have lots of safeguards in place to ensure the program will continue to deliver the benefits we would like it to deliver in the context of very uncertain factors that could affect the performance of the program. That's brief update on RGGI. There's of course much more detail in the annual report. I'll also say just a couple words about the Transportation and Climate Initiative, or TCI. You can see the map of the participating jurisdictions in TCI right now. It's effectively the same map that I showed earlier. It's a very similar group of jurisdictions, and TCI would be a potential cap and trade program, cap and invest program for the emissions from transportation fuels. It's still under development. The states put forward a potential memorandum of understanding, a draft of a memorandum of understanding that interested governors would sign. We put that forward in December, gathered comment through the end of February, received many comments, and we're digesting those and working on next steps. And the sense, so many of us are also RGGI participating states. We are drawing substantially from the experience in RGGI as we design this potential cap and invest program for transportation. And that program could begin as early as 2022 in the participating jurisdictions. So those are quick updates on what's the latest and what to expect for RGGI and TCI. I'm looking forward to questions.
Many thanks, Chris. I would now like to give the floor to Hans Bergman, who is the head of the ETS Policy Development and Auctioning Unit in DG Klima at the European Commission. He's been working at the European Commission since 1995 on various issues, including energy governance, the effort sharing legislation, MRV, and allocation under the EU ETS, among others. Thank you for joining us, Hans, and the floor is yours.
Okay, good evening or morning, everybody, and thanks also from my side to ICAP for organizing this and for the report. So indeed, we are a bit turbulent times, but work continues. So I will explain to you a little bit what is going on for us and some highlights of the last year. So if I can have the next slide, please. So the big thing what happened last year was that we have the new mandate for European Commission. It's a bit like we have a new government. It happens every 5 years, and this new Commission decided that the green aspects was the most important for issue to face, which was both climate change and environmental issues. So they decided to create this term European Green Deal, to make sure that we can handle our climate and environment in a good way. This implies that although we had done a lot of work just before to finalize the update of ETS and our whole energy and climate package, we will now have to reopen that again to make it more ambitious. In last year, there was a lot of discussion among the EU member states about the long-term strategy and the aim to have reached climate neutrality, and that has been basically agreed in December 2019. One member state somewhat hesitant, but otherwise that is European leaders, the prime ministers in principle, have agreed that to be the EU's 2050 objective. This is now also was put recently in legislative proposal. So that was the first European climate law that was a few weeks ago presented and to the legislative authorities we have, the Parliament and the Council. And that puts then this 2050 target of climate neutrality into legislation. We will see now, of course, the whole work of the system is a bit slowed down. So let's see how soon that will be adopted. But we think it should, in principle, have big support both in the Parliament and among the member states in Council. We have been continuing doing a lot of implementation work because, as you might know, we have a new phase of ETS starting in 2021. So that is quite soon. So I will come back a little bit to that. And then also our work on the international engagement on carbon markets and climate diplomacy continue and has also been much supported by the new European Commission. Next slide, please. So a few words about the Green Deal to a bit more detail. So the aim is to really transform the EU's economy for a sustainable future. And a very important aspect is also that nobody's left behind. So the aspect of a just transition is very much focused, because we know, and the Commission knows, that it is a good thing, but it's not easy for everyone, this transformation, and to not have the backlash that we have seen, we have to have everybody on board. So it's a lot about climate ambition, but also clean, affordable, secure energy, industry and circular economy. The whole building sector needs to be much speed up its renovations. We should also have a zero pollution ambition and toxic-free environment, and very much focus on ecosystems and biodiversity, the farmers, and also mobility. So this is all making, I would say, all EU policies should from now on, and I think one can notice a big change the last 6 months, that all policies are really having this, say, climate and environment element into it, financial policies, tax policies, you name it. Okay, next slide. So just to recall that we had a co-decision, we call legislative process, to revise the EU ETS for its fourth phase, 21 to 2030, and that basically strengthened the EU ETS to become more ambitious with a steeper cap reduction. We also kept the free allocation in principle, but more ambitious benchmarks for the free allocation, and also a bit more flexible system. There was also creation of 2 funds, which I will come back to, the Modernization Fund and Innovation Fund, and in order to finance this transition with the help of ETS funds. Maybe I should also mention briefly on 2019 what some numbers we had. We had verified emissions were down 4%, 2018 compared to the year before, and we had revenues of about 14 billion euro to the member states from auctioning. And we had also the first year that we had the operation of our market stability reserve, which took away 400 million allowances from the system that otherwise would have been auctioned, and now are put into a reserve that might possibly be all cancelled, but at least they are put aside for the foreseeable future. Next slide, please. So I don't want to go too much into details, but this is about the work we are doing to work on the free allocation to make the system more. One of the main things with the free allocation that will change as from 21 is that it will become more dynamic. So based on production data from just the year before, now we have a little bit more fixed system. We will also have more regularly updated benchmarks on which the free allocation is based. And we also have specific rules where the member state can compensate companies for higher electricity costs due to ETS, and they will also be adjusted. We are working on that right now. Next one, please. Yeah, so just mention that these 2 funds we had the Innovation Fund, which is using at least 450 million allowances to be auctioned to support innovation in the energy-intensive industries for renewable energy, energy storage, and carbon capture and use. So depending, of course, now on the carbon price, but it can be up to 10 billion euro that can be support investment in this area. Then we have this other modernization fund, which is also a sizable fund, which will be even larger probably, and which will help to support the modernization of the energy systems in just transition in the 10 lower income member states. So we are now working on both of them to make them operational and start the auctioning of these allowances intended for these funds. Next slide. Yeah. Oh, I don't think I can read everything on this one. But just to mention briefly, one thing in the European, the Green Deal that came up was that the fact that, as you know, we now have emissions divided in EU ETS, is basically big installations and power and industry. And then we have the other emissions is road transport and building sector is the responsibility of the member states. But we have now a project to assess whether these 2 sectors, road transport and building, could be part of the EU ETS one way or another. As you might know, Germany have done something in that direction already, creating a specific sort of emissions trading system for these sectors, and we are looking at that also now. And this will be assessed of the year to come. Next slide. So in conclusion, okay, now the text came, but okay, you can read it another time. Yes, so the Commission now recognizes even more in the Green Deal that the robust carbon price is important to reach the low carbon transition and climate neutrality. And we are working on to put in place the reform as from 2021. We will now restart new work to make the whole EU more ambitious. I didn't say ambitious, but I didn't say it, but we are also already looking at how to increase the 2030 target, which is now minus 40% compared to 1990 to 50 or 55%. And in that work, it's likely that ETS will also be impacted, of course, since it covers half of our European emissions. And we will also review the market stability reserve, etc. So a lot of work. We will have some work coming, some results coming up already in September on which 2030 target we will have, and then we will also June 21 come with a legislative proposal for how to modify the EU ETS. All of this will be linked to impact assessment, public consultations, etc. Thank you.
Thank you very much, Hans. I would now like to pass the floor to our last panelist, Fernando Gutierrez, who is the director in the General Direction of Climate Change Policies of the Mexican Ministry of the Environment and Natural Resources, commonly referred to as SEMARNAT, in Mexico. He's a PhD candidate in international relations and has worked on many topics in the government, such as climate finance, international cooperation, and capacity building for the Mexican ETS. So without further ado, Fernando, the floor is yours.
Thank you very much for the introduction. Stephanie, can you hear me now, all of you?
Yes.
Yes, okay,
Thank you.
Great. And can you, okay, so I'm gonna be talking about the latest developments for the Mexican ETS. Congratulations to the ICAP Secretariat for the new report, and it's a pleasure to be here with all of you, especially such great partners as the California Resources Board and RGGI and the European Commission, as well as the ICAP Secretariat. So I'm gonna be presenting the latest developments for the Mexican ETS from 2018 and on. As you know, regarding the climate change policy framework, the general climate change law is a live instrument derived from the National Development Plan and the national objectives, as well as the sectoral programs for the Ministry of Environment, aligned with the climate policy instruments. The emissions trading system is one of many instruments, including the Climate Change National Strategy, the Climate Change Special Program, the National Adaptation Policy, the Climate Change Subnational Programs, and the National Inventory of Greenhouse Gases, greenhouse gas emissions towards our compliance for Mexico's NDCs. Regarding the general climate change law, we have been working closely with California and Quebec regarding the knowledge and skills exchange, as well as with California in the review of the preliminary basis and the shared experiences for early actions program and compensations, as well as handling of market-related data. With the European Union ETS, we have also been working closely together to achieve Mexico's compliance. Now, the climate change law amendments published in July 13th of 2018 establish a mandatory regulation for the ETS with 36 months pilot program prior to the operational phases, with no economic impacts and no impact in competitiveness. And therefore, the regulation must be prepared for the pilot phase starting 2019. Now, regarding the pilot phase, which has begun in January of this year, it establishes as a mandatory compliance periods of 1 year for these 3 years, a scope which includes energy and industry, a threshold for participation, flexibility mechanisms like banking and offsets, MRV requirements, a centralized registry for the Ministry of Environment, a cap that includes more or less 271 million tons of carbon dioxide equivalent, including around 300 installations, and an allocation by installation. The cover sectors are energy and industry. The allocation is going to be free through grandfathering for participants for this pilot phase. And there's going to be an offset usage limit for compliance of up to 10%. Now, for 2020, we're working on the internal procedures regarding the development of internal procedures for the general direction of climate change, the analysis and storage of information. We're also working on the registry, which is the most important phase for 2020. PMR has been a great ally for this, and we're working on the development of the monitoring system, the tests and maintenance. We're also working with PMR on the development of offset protocols regarding the offsets program, criteria, procedures, and verification, which includes landfill. We're also exploring blue carbon and considering also forestry and others. We're also in the process of integrating the advisory committee. The information of this committee includes 14 representatives and 4 observers. 8 are non-government, 8 from business chambers and bankers association, 4 from government ministries, including environment, energy, finance, and economy, 2 technical experts, which are INEC and CONAFOR, and 2 observers from civil society and academia, 2 from each. We're also working on training, meaning capacity building for regulated and interested parties, which is going to be very important. As you already know, Mexico has been working on implementing the ETS for many years now, beginning with the carbon market exercise, in which we built capacities within the private and public sectors with more than 100 of Mexico's most important companies. However, this capacity building is going to be more focused on the implementation of the ETS as such. We're also developing many studies for which GIZ has been a very important ally for a mix of policies and co-benefits and auctions, and the evaluation criteria for us to be able to transition in 2021 into our final phase for the implementation of the regulatory ETS. As you can see here in the timeline, the pilot phase includes 2020, 2021, and 2022. 2020 this year is going to be the most important for us to be able to advance into the transition year, and therefore for the operational phase, which we're working on in daily basis. And the 2022 is going to be a very important year for us to be able to implement the regulation as such. Thank you.
Thank you very much, Fernando. And don't turn off your camera, because now we are starting the Q&A session. So for this, I'm going to invite all panelists and myself to turn on their cameras. And I get, as you can see, this beautiful background, which is the cover page of the status report. And I would like to ask one question to each of you that we received from the Q&A. So a question to Jason. Are you concerned about the allowance price drop in WCI markets in light of the coronavirus fallout? And does that drop require any further measures to correct course?
Yeah, great question. I think we all kind of anticipated that folks would be watching that. What I'll say is, I mean, we're definitely watching what's going on in the market. And first of all, hoping everyone is staying safe. Our program does have mechanisms, as William mentioned in the very beginning, as do other ETSs, in terms of assessing changing demand. For instance, our program has self-ratcheting mechanisms within our auction structure. As the market operator, I don't really have any other comment on what's going on in prices. We're not going to forecast or project anything that might happen. I think our program has designs to try to take that into account. But we're definitely watching what's going on, and as I'm sure is everyone else.
Indeed. Thank you, Jason. Next up, I have a question for Chris. It's a very short question. Why is the RGGI going up in 2025, 2026?
It looks like that on the graph that I presented, and that represents the expiration of the next round of bank adjustments, which will take effect in the years 2021 through 2025. The base cap continues to decline every year, but in those years 2021 through 2025, the effective cap will be lower because we'll be implementing these bank adjustments, sort of reducing those near-term caps by an amount equal to the extra allowances left in circulation after accounting for emissions through the end of this year.
Clear. Thank you for that. One question to Hans from Mayra de Silva. Would the current low prices of EUAs have an impact on the potential implementation of a carbon border adjustment?
Well, to be honest, good that at least the issue is mentioned, because I don't think I mentioned the carbon border adjustment possible, but it's part of the Green Deal. Was also the concern that if the EU will become much more ambitious in the climate area, there's also a high risk of carbon leakage and competitiveness, and therefore we have been asked by our political masters to assess and evaluate the possibility for some sort of carbon border mechanism to avoid carbon leakage. That is now, of course, quite, as everybody knows, neither very easy and not completely uncontroversial. So, but anyway, that work is ongoing, and we are very early stage on that. One can, of course, in theory, say if the carbon price would be very low, there is much less risk of competitiveness aspects. But we are, of course, looking now in the long term, like also some of my colleagues said. So, and we have the also, like other systems, this market stability reserve, so in force, so in case there will be an increase of the surplus of allowances because of reduced emissions, we have a mechanism to absorb quite a large part of that. And that together we will have also increased ambition, and this mechanism will also be revised in this coming year or so. So in the long run, I think nevertheless one can expect the carbon price to be pretty much on an upward trend.
Great, thank you for that. I have a question for Fernando from Paula del Rio. When will the rules for offsetting be released? Specifically, the specific sectors that will be eligible to provide offsets.
Yes, thank you. We're still working on that. We're developing the offsets protocol, both for early action as well as for the implementation of the ETS. So we're still working on that through studies, and it'll be determined by I think, last quarter of this year, before the national registry is already ready for us to be able to advance in this matter.
Okay, thank you. I have a question to all of you, actually, from Catherine Lining from Motor Economic and Public Policy Research in New Zealand. How are systems assessing evolving emissions leakage potential under the Paris Agreement and potential global recession? And how will free allocation be adjusted accordingly? So I'm going to repeat. How are systems assessing evolving emissions leakage potential under the Paris Agreement and potential global recession? And how will free allocation be adjusted accordingly? Anyone interested in taking that question?
Maybe start, but at least to say that, okay, we are now in a situation that is there since a couple of weeks, and we don't know how long it will last, first of all. I think we all, at least for the EU, we have rules in place, and it's nothing you change from one day to another. So I think the rules we are now, as I said, we're working hard to put in place the rules on free allocation that will apply for which are already in law, and now it's the implementation more in practice, so that it's all ready for the start of the fourth trading period in 2021. So I think it's not really something to comment much about. of course, we have to see how the whole economy, the world changes. But in principle, you know, the legislation is there. It's nothing you change very easily.
Yeah, I guess I'll just sort of echo that, but also say that as a subnational jurisdiction, we're not party to Paris, so that part of the question isn't directly applicable. I think what you'll find from a lot of our thinking is what additional mechanisms do we have to recognize where emission reductions are harder. So I'll point back to our carbon neutrality workshop on the industrial sector for additional thinking of how else can we help generate emission reductions and incentivize those reductions. Our last rulemaking really focused on legislative mandates for what our leakage percentages for all allocation will be. So I'll point to some of that as well, but otherwise echo what Hans said.
Cool, thank you. I have a question to Chris. Chris, what do you think are the chances that New York State will be part of TCI?
Sure. So I can't speak for New York State or any other particular states, but I do think that it is the goal of all of the states as we design a potential TCI program to design in a way that enables the broadest possible participation from the greatest number of jurisdictions. So beyond that, I don't think I can speculate on what any individual state will decide to do. I will note though that our colleagues in New York have been very helpful participants in the TCI process. Not only for the last year, 15 months that we've been working intensively on designing an ETS, but also for the last decade that TCI is actually a pre-existing collaboration among many of the states working on transportation issues, and New York has been an active participant for that entire time.
Fair enough. Thank you. A question, I'm getting lots of very good questions. I hope you don't mind. I continue asking them for as long as we have time. So I have a question from Paulina Santos Vallejo Machado to Fernando. Are there any advances on the definition of the legal nature of emissions allowances in the Mexican ETS?
If you mean the cap and allocation, yes, well, it was determined based on the historic emissions from the National Registry of Emissions for Mexico, the NDC targets and the sectorial targets. Those are already in place for the pilot phase, and that's what we've included for this phase.
Okay, thank you. A question from Jerry Seeger to Jason. What are the main countries or subnational jurisdictions that California Air Resources Board expects to see using the tropical forest standard? And in answering this, perhaps you can just give a very brief introduction to what the standard is.
Sure, yeah, so our standard, and I mentioned this a little bit in the presentation, is looking to help send a signal for jurisdiction scale programs to reduce emissions while doing really close collaboration and partnership work with indigenous communities and local communities. Our work on this standard really has been done with about 37 other subnational jurisdictions from 10 countries over the last decade as part of something called the Governor's Forest and Climate Task Force. And we know that there's strong interest from some of these jurisdictions, states and provinces, working with indigenous peoples and local communities in those jurisdictions to develop their processes and legal requirements to demonstrate ambition to reduce emissions and to benefit those communities. So I think we're looking to see if the GCF jurisdiction, states and provinces will be taking leadership initiatives to demonstrate their action, and many of them already are. So I think that's where we're thinking folks will probably first use the standard.
I have one more question to you, Jason. With prices going down to $12.50 USD for allowances, how do you think this will affect participation in the May 2020 joint auction, where the reserve price is $16.68?
Again, I'm not going to speculate on auction participation for future auction. We've scheduled it as our regulation requires for May 20th. and the results of the auction will be what they are. So I can't really speculate on what that might be.
A question to Hans. Hans, what is the status of the EU's discussion with the UK? Do you expect them to link with the EU ETS?
Yeah, I think you can guess my reply to that. But what I can say is that although the UK has left the EU, they are part of the EU ETS until for this year, so until the end of 2020. And they will then do the compliance in 21. But then what happens then? I think no, I have no comments on that. There is of course negotiations, and we have to find out what both sides want. But in general, we would like to have a close and good collaboration with the UK. But I think first maybe UK should decide if they will have an ETS and how it will look like, and then we can, see from there.
Great, thank you for that. I have another question to all from Luca Lore from IACCXG. How has the lack of outcomes on the operationalization of international carbon markets at COP25 affected your programs, if at all? For the linked systems, maybe?
Sure, I'll go. And I guess as one of the members on this panel that's not a member to the UNFCCC, I think that our collaboration, our domestic program here in California at the state level, as well as our partnership with Quebec, continues to work very strongly. I think it demonstrates the need for carbon pricing, both within our portfolio approach in California and the ability for that to connect to a jurisdiction like Quebec. So I think for us, it's continued to be a very, very important part of our program, irrespective of the results at COP25. And I think as the ICAP report is showing, it seems that this is still a very important and growing tool for many jurisdictions to use at the subnational and the national level.
Great, thank you. I have one more question and then we close. Question to Chris. What chances of linking TCI with another cap and trade program in North America, either WCI or RGGI?
Sure. So the approach we put out for comment in December was that we wouldn't sort of immediately link the program, but we would try to design it to enable linking in the future. And of course, there are multiple programs to choose from in North America where that could potentially be possible. So our goal is to make sure that we have that option as we design the program, but initially design a program that can stand on its own without linking.
Fantastic. Many thanks for this. And with this, and right on time, I would like to conclude this webinar. There are many more questions we could discuss, but time is short. So I would like to give a very warm thank you to the panelists and also to all participants joining us today. Many, many thanks for your input. And we hope that you will continue to stay engaged with the ICAP Secretariat through our website and Twitter to continue the conversation. So thank you very much, everyone, and have a nice evening in Europe and day in the Americas. Thanks a lot.
Thank you.